Okay, guys, we are going to go ahead and get started. Welcome to class. As you can see, we have a guest speaker today, so we're lucky to have Danny Wallace. I'm going to let Danny give you a little bit about his background once we turn the mic over to him.
Okay, great.
All right, thank you.
Okay.
Get started.
Good morning, everyone. So hopefully everyone can hear me. So let me just introduce myself first of all. So my name is Danny Wallace. I was an audit partner at PricewaterhouseCoopers for 25 years. I spent those 25 years here in Silicon Valley, and my focus when I was with PwC was on startup companies. So this presentation is really all about startup companies and the startup environment and what you need to know from an accounting and a finance perspective, particularly if you're not finance and accounting oriented. And so really, I would best describe my presentation as a summary of my professional experience over that 25-year period. And it was basically the type of advice that I would give to CEOs and founders when I'd first meet with them, and then ultimately as I'd work with them, through their journey, hopefully from startup through the various rounds of financing, and ultimately to a public company. That would be the ideal scenario. So some of the companies that I work with, many of them you won't have heard of, but some of them you might have heard of. So Uber was my client when it first got started. Twitter, obviously now X, DoorDash, a lot of companies in that space. I worked with Airbnb when they first got started, and then many companies that you will not have heard of. But so hopefully this presentation is useful if you're focused on maybe thinking about being an executive at a fast-growing company or starting your own company. So the slides are pretty dense. I'm going to go through them quite quickly. And so some of the things we're hoping to cover today, I'm going to explain what the accounting function is and why it's important. Obviously, I have a particular bias being a CPA. How the accounting function evolves at different stages of a company's journey, why financial statements are important, particularly from a fundraising perspective. I'm going to talk about accounting controls, which might sound boring, but they're essential, right, to protect the funding that you raised. Going to talk about some key accounting decisions that CEOs need to be involved in. I'm going to touch briefly on IPOs. I've done a lot of IPOs when I was at PwC, fortunately. Spend a little bit of time talking about key metrics, which are non-financial related data, and then just try and round it off with 5 common themes that I saw during my time at PwC. Okay, so why is the accounting function important? I would say I always think of accounting as sort of the poor relation to all of the other departments, but a lot of it makes sense, right? So first of all, when you start a company, you're really going to be focused on product, right? And developing the product. You're going to be thinking about product fit, product design. You're going to be thinking about the marketing, and then you're going to have to think about how to sell the product, what channels to use. So accounting naturally comes at the end of all of that. Now, unfortunately, it's often left too late, right, to make some of these very important decisions about accounting and finance, because it is an incredibly important part of the organization. And just as you would want to hire the best engineers, the best marketers, and the best salespeople, you should be thinking about hiring the best finance and accounting people as well. It's just a natural evolution. But because it comes at the back end, it often gets the least amount of attention. And just some of the areas that accountants and finance folks are involved in are very critical to the company, right? So you've got fundraising. So you could have several rounds of fundraising, right? And we'll talk about fundraising in a little bit here. But maybe you go from your seed funding all the way through maybe E, Series E, and Series F. You could be doing 6 or 7 rounds of fundraising. You need finance and accounting people at the table with the investors when you're raising funds. Mergers and acquisitions, I just shortened that to M&A. Highly important. I'll spend a little bit of time talking about some things that come up in due diligence in an M&A environment. Obviously, initial public offering. You can't do an initial public offering without a really good finance and accounting team internally. And then once you're a public company, you've got all of the things that go along with being a public company, like setting earnings estimates, for the following quarter, for the year. You need a really good financial planning and analysis team to be able to do that. The street will set their expectations based off your conversations with the street. Then you have the compliance part of all of this, filing financial statements with the SEC. It's a legal requirement. Tax returns, again, more legal requirements. So you can't ignore those. And I will touch on some pitfalls where you can have some serious issues if you don't deal with these on a timely basis. Audits, obviously, public companies need to be audited. Most private companies, even though it's not a legal requirement, at some point you'll need to be audited. Maybe not the first couple of rounds of financing, but once you get into maybe a later stage, the venture capitalists or the other investors are going to insist that someone's kicked the tires on the financial statements. So they're probably going to want an audit. And that's where, when I was at PwC, I would meet most of my clients, was probably on that Series B or Series C round, where they were doing their audits for the first time. And then we'll touch a little bit on internal controls. I'll talk a little bit about fraud. Every client I've had as an audit client has had fraud, right? I don't think it's something associated just with me. I think it's pervasive, right? So we'll spend a little bit of time talking about that. So my overall advice is not to be cheap when it comes to accounting and finance, right? It's worth paying for quality like everything else. My advice to my clients was always to hire really high quality people, right? So pay that little bit extra, right, to get the best hire that you can. It'll save you a ton of money later, right? If you hire somebody who is not particularly wholly competent, there's going to be lots of mistakes that they're going to make, and maybe they don't get identified till much later in the process. And typically they've compounded at that point, and so you're trying to unwind, a big ball of spaghetti. And I'll show you a couple of examples of that. You really want to hire high quality leaders, and if you hire a high quality leader, they'll tend to bring really high quality people with them, right? And my experience is if they're not able to do that, then they're probably not the right hire, right? You probably should have hired somebody else. I'm always a very sort of sound proponent on checking people's credentials. Do not listen to listen to the investors, but don't let that be the last word. So if you're getting a recommendation from a venture capitalist, that doesn't necessarily mean that's the right hire for you. That person may have helped the venture capitalist exit at the last company at the expense of the CEO and the rest of the team, right? So of course they're going to give you that person's resume because they did such a nice job for them at the last company, right? So you have to do your due diligence. You really do. There is a lot of mediocrity in the accounting profession, and particularly here in Silicon Valley. And I tend to think it's just because the early boards and founders are not that savvy when it comes to finance and accounting, right? So they're really not looking at the right things when they hire people, and really not taking action quickly enough to exit, people who aren't strong performers. Okay, and finally, it's a very creative profession, right? So you really want somebody who's creative, but you don't want somebody who's too creative, right? So that's always something to keep in mind. A few high-profile CFOs that ended up maybe being just that little bit too creative. So I'm going to run through what the accounting department looks like by life cycle, and I'm using life cycles, funding stage life cycles. So hopefully you're familiar with that. I just thought I'd put this up. So this is credit to PitchBook here. I'm sure you're all familiar with PitchBook. So this is from Q1 2025, and it's basically median deal sizes. So I've used this terminology here for my snapshot of all of the accounting function at different stages. So you can actually see some interesting trends here. Obviously, 2020 and 2021 were the haymaking days for companies when they were raising finance. Obviously, the fundraising scene has gotten a lot tougher, right? Unless you have AI in your company name, but otherwise it's a very, very tough fundraising scene right now. But if we look at the just each of the different stages, so I'll focus on seed. So that's the very first round of financing, essentially friends and family, maybe some angel investors. some wealthy individuals. So you can see the median there is $3 million. Obviously, there are extremes, right? If we go to early stage VC, that's sort of your Series A round, your Series B round. And again, it's 5.5, I think, is the median there. And I've had some clients do A rounds that are $50, $75 million. So obviously there's a large distribution range there. Then we get to late stage VC. So that's maybe Series C, Series D. And then we have venture growth. So that's anything sort of Series E and above. So you're getting ready to go public. And again, there's a huge range, right? You can have hundreds of millions. That $100 million round would be a mega round. So you could have a mega round included in venture growth, as well as some smaller rounds. So let's look at each of those stages. So seed stage.
Yeah, I have a basic question. These series that you're talking about, is that an SEC designation? I mean, who decides what is it?
No, so it's basically a legal designation that's put on the funding document. So the very first funding document you'll do with a venture firm is a Series A. And then the next time you raise money, it's going to be Series B, then Series C and Series D and Series E.
So it's defined in
the venture agreements. So if you look at a funding agreement at a company, you'll see right at the top, it'll say Series D, Series E, whatever the series is. But basically, if it's the first round, it's A, second is B, and so on. If your company's doing a Series W, then you're in trouble probably. You probably want to have exited before that. But so it's the name given to the funding round. Not very imaginative. I agree with you. But so seed stage, really the company's just gotten started, right? So you're not going to have a CFO. You're not going to be able to afford a full-time CFO, right? You're going to be spending that money on engineering resources and something that's more essential to the company at this stage of its life. Typically, they're outsourced. So there are lots of companies in the Valley. It's a great place to be, obviously, if you're starting a company. There are lots of boutique firms that exist that will provide the sort of fractional financial advice that you need. So maybe they come in, one day every 2 weeks, and they'll provide you with a bookkeeper, but they're not your employees. You're paying them on an hourly basis. Some of them structure their fees so that it's 50% cash, 50% equity, because obviously as a startup, cash is king, right? You're trying to conserve your cash as much as possible. Every board meeting you go to, they're going to talk about your burn rate, which is how much cash you're spending every month. They're going to talk about your runway, which is how much cash you have left at that burn rate, right? So everything's focused on cash. So you can't really afford to carry a finance and accounting team. You don't need a full finance and accounting team. You're really doing the basic stuff. You have to pay people, particularly your employees. You have to pay vendors. You have to file some essential returns. So nothing very sophisticated there. So that's seed stage. And then you get your first funding round. So now we're in early stage. So this could be Series A and B. And I said the median round is 5.5 million. Again, you're focused on cash conservation, right? You really want to do as much as you can with the cash that you have. No guarantee you're going to get another round, right? So you're really focused on preserving cash. So maybe you have a part-time CFO now because you're potentially talking to investors about, the next stage of funding. So you need a CFO to help you with that. You may have some in-house personnel. You're probably still outsourcing a ton of stuff. Not using very sophisticated systems, not regularly reporting your financial results. You're not running off balance sheets every week. You'll look at when you have a board meeting and you'll probably gear all your financial statement presentation to that board meeting so that you're ready for the board meeting with the investors. And then as we get a little more sophisticated, so later stage, so you've done your Series C or D, median round 7.2. For each of those, you've actually got a product, you're generating some revenue, hopefully. Probably not enough to put you in a profit situation, but there's revenue coming in, so it's a little more sophisticated now, right? You've got your cost of revenue, you've got all your operating expenses, so you're probably going to start using some software. more and more of the accounting process will be automated. You're probably putting more controls in place around business operations and the accounting operations, and we'll talk a little bit about some of those. And you might have a full-time CFO. At this stage, though, you could still have maybe a part-time CFO that's helping. Depends really on the company. And then when you get to venture growth, you really have a full team now. You've built out the finance team. You've got the accounting team, the accounting organization. You've got a financial planning and analysis team that you're putting together. You're probably thinking about going public and preparing for that IPO event. And that's when you really start doing a lot of the hiring, right? Probably got a full system on board, so everything's automated. You've got some really good controls. You're starting to produce financial statements and have a very sort of rigorous close process. That's where you close the books and you produce the financial statements for the board and for other users, other stakeholders. So really getting ready to become a public company. Maybe there's also some tax planning that's going on here. You're thinking about your international structure. If you're dealing in foreign currency, again, you're probably using foreign currency strategies. You may have surplus cash at this point, so you're investing in a treasury department now to maximize the use of that cash. But really, for all intents and purposes, you almost look like a public company, except you don't have that public company reporting obligation at this stage. So that's how the accounting department evolves. So it's a gradual process, and again, it's all about making quality hires at the right time and bringing someone who can bring other people with them. For fundraising, it really depends on the investors and on each venture firm, and it depends what stage you're at. But if you're getting closer to sort of late stage or even venture growth, you're probably going to need historical financial statements, hopefully audited, that you can present to the investors. You'll have financial projections, pretty detailed for the next 12-month period, and then probably less detailed for the 2 to 5 years potentially after that, showing your growth projections. You're going to have a use of funds statement. So I'm asking you for $50 million. Here's how I plan to use that $50 million, right? So that has to be quite detailed when you sit down with investors and explain how you're planning to use the funds. You'll give them a bunch of other details as well. So capitalization table is who owns the stock, right? So you will share with them who the stockholders are, and not just the stock that you've issued, but also options and warrants that you may have on the stock. So obviously options are probably going to be mostly for employees, potentially other service providers that aren't employees. Warrants could be for example, for the landlord, to the bank, and so forth. But the venture capitalists or the investors, they're going to want to know what their dilution is going to look like once they make the investment. So it's very important for them to have a very rigorous capitalization table. Typically, it's something that the attorneys will maintain at this stage. So they'll be able to tell you exactly what the cap table looks like and provide all that information.
Danny, sorry, are these venture capitalists looking for assurance on any of these documents? Are they asking for example, audit opinion on projections or anything of that nature?
Typically not, no. Certainly not on the projections. And if your cap table is coming from a well-known law firm, they're pretty comfortable with that. You know, the fact that it came from, Wilson Sonsini or Fenwick and West here, that, they're probably going to take that as, whether they should or not, because cap tables are hard to maintain, but they're going to take that as gospel, basically. And they may or may not ask for audited financial statements. Depends who the venture firm is. But it's good to be organized so that you have all of that ready, just in case they do ask for it. Board composition. Typically, venture firms, only like people who have skin in the game to be on the board. So I've seen this. I'm from Ireland. I've helped a couple of Irish companies get funding here, and in Ireland, and I don't think it's necessarily just unique to Ireland. They put everyone on the board, right? You invested $1,000 or £1,000. You're on the board, right? You were my friend in grammar school. You're on the board. So quite often what they'll do is they'll kick all of those people off the board. And so you typically only get a board seat if you've got real skin in the game, i.e. you invested a chunk of money. And so it's important for you as well to make sure that the board is pretty contained. You want a fairly small board, in the companies that I'd helped, like you had 25 people on the board for a small company. So you could really never make a decision, right? Unless you got everyone in the pub, and then it was very easy to make a decision. But you have to keep the board pretty tight. The investors will do their own quality of earnings. That's called a QOE review. So they'll basically take your projections and smile politely, and then they'll in the back office they'll kind of rip them up and do their own projections and come back and have that conversation with you later.
Sorry, Danny, I'm that nightmare student that won't stop asking
No, you
questions.
are.
If you have people on the board, and I hear you saying that one of the ways they're getting on the board of directors is through their skin in the game, the amount of capital they have invested in their entity. How does that impact the ability of the board to exercise a certain amount of independence when it comes to their responsibility for Sarbanes-Oxley requirements of, say, audit committee, that sort of thing?
Sure. So everything I said about the board is as a private company.
Okay.
When you go public, and as Professor Lord said, Sarbanes-Oxley kicks in, you have to have an independent board, right? So what you'll see, and I'll touch on it very briefly, is as you go public, the board really expands, but you hire independent board members. And so that gives you the independence aspect. At this stage, the boards aren't independent, right? They're all invested heavily in the company. The people you'll have on the board will be the venture firms that invested in the Series A, the Series B, the Series C. You'll have the CEO on the board, maybe the founders on the board as well. So it's not an independent board at this stage. That doesn't necessarily mean they're all aligned, but it's not an independent board. So fundraising trends, I just thought I'd put this up. I mentioned it a little bit earlier. So you can see here, these are annual trends, and obviously we just got 1 quarter in here for 2025, but it's been a very challenging fundraising environment for the last 2 or 3 years, sort of post-COVID. COVID were the glory days when it was very easy. Well, I won't say very easy, but it was a lot easier to raise finance at a high valuation. Now the tables have really turned, right? Now you'll see for 2025, that's still a 91 billion, still a pretty healthy number for just 1 quarter, but it's a little bit misleading because included in that number are certain AI companies, right, that have scooped up 71% of the capital. So you're all too young to remember when I first got here, the timing was perfect. The internet was just taking off in 98, 99, and everyone changed their company name to have .com after the company name. And we're sort of in the same place now, but it's .ai or AI, right? So everything is having a tough time raising money at a good valuation, except for AI companies. It's still like 2020 and 2021 for AI companies. They're still able to raise at very, very high valuations. Some would argue unreasonable valuations, but very high. Much more challenging environment for non-AI companies, regular companies. And interestingly enough, I think about a third of the companies that had large raises in 2020 and 2021 at high valuations, they haven't gone back yet for subsequent fundraising. So my guess is when they do, they're probably going to have significant decreases in valuation when they sit across the table from investors. And it's a tough environment for venture capitalists as well, because we'll talk about this a little bit later, because the IPO market is dead. They have not been able to distribute to their limited partners, the institutional investors. And because they haven't been able to distribute, they haven't been able to raise. So unless you're a top tier VC, you probably have had a really tough time raising additional funds, additional capital to invest in startups, which again makes the whole investing landscape a little more challenging. But hopefully it will all change. It will all change. Everything's cyclical here. So once that IPO market opens up and the exit market opens up, I think we'll see this much more healthy fundraising environment. So I did want to talk about fraud. There are different types of fraud. I'm not going to talk about accounting fraud like some of those CFOs that we saw on that earlier slide, like Enron, for example. I'm not going to talk about business fraud, which includes people using your platform for fraudulent purposes. So think marketplaces, for example. I wanted to just talk about good old-fashioned internal fraud, right? So essentially employee fraud. You can see some of the stats here. 2/3 of all US small businesses have had fraud. I think I told you almost every client I've had, and that's hundreds of clients, have fraud at some level. Stealing assets, so asset misappropriation, i.e. typically cash, is the most common type of fraud. Most of the frauds are discovered, the single biggest source are whistleblowers. So, fellow employees, right? Some people will call them snitches. I think they're good corporate citizens. Okay, so common fraud schemes. And again, I say at the bottom here, this list is neither exhaustive nor suggestive, so I don't want you to try any of this at home. But some of the common fraud schemes are good old-fashioned ones. So personal expenses characterized as business expenses, i.e. I never took that trip, right? Or sorry, I'm using this for my own personal purposes. I'm going to expense it as a corporate expense, something I needed for the company, maybe a laptop I bought or something. It was really for my son. Expenses never actually incurred, but submitted for reimbursement. So think of Adobe Photoshop. I have a hotel bill that was a genuine hotel bill, and I just doctor it again, and I submit it. It gets reimbursed. You might think this is highly unusual, but it's actually quite typical, and you'd be surprised at the level of people that will do this. So these are, the ones that I have seen are, quite often senior management. So on very good compensation packages, willing to risk it all for, a $3,000, expense reimbursement, right? Which makes no logical sense. Maybe it's the thrill of the chase. I don't know, but I've seen like a number of it would be a good psychological project, I think, to figure out why people do this. But I'm never surprised when I see it. Had one CEO who was a public company and also on several boards in the Valley here, and really he would go on business trips, would claim that his luggage was stolen and submit expense for some high-end luggage that he bought, or a cashmere coat or something like this, just stuff that he could easily afford on his own. That whole thing came crashing down. He got fired from his very lucrative position as CEO of a company, left $50 million of unvested stock awards on the table, which were cancelled, lost every board position that he had, all for, I don't know, $20,000, just makes no sense. Falsifying sales to generate commissions. So this is on the sales side. Most sales employees are paid by commission. They get a percentage of a certain, whatever the value of the deal is, the total contract value of the deal. And they will submit some deals that really aren't revenue deals. They'll get paid their commission. Maybe they leave before somebody figures out, hey, that was not a real deal. I was involved in a couple of these where I ended up having to go and testify as a witness on behalf of the company, some cases that went to court. Kickbacks from vendors. So this quite simply is, this is a tough one for startups, because as they expand internationally, they don't really know people in the market. The international markets they're going to, at least not initially, and so they're going through third parties. Those third parties quite often will put them in touch with vendors who may charge above market rates, and then split the profit with the partner, with the employee that negotiated the arrangement. Hard to find, but it happens a lot.
Danny, I'm sorry, can you say a little bit more about, you were called to testify? Was that as just someone not involved, or you were involved?
No, so it was basically when we were doing the audit, we came across a couple of this is with software companies. It's quite not uncommon for software companies to be the biggest source of these falsified commissions. And the deal just didn't look right. I mean, the way the deal was papered, it just didn't make a lot of business sense. So we kept pushing on this deal. We ended up talking to the customer. The customer provided a whole bunch of information that contradicted what the salesperson had told the company, which invalidated the deal. That person ended up getting fired. It was the VP of sales for the US, ended up getting fired. He brought an action against the company for unpaid commissions. Ended up in court, and we were called as witnesses to describe why, why, from an accounting point of view, why the deal didn't make any sense. Kickback from vendors. So gift cards or incentive codes. So marketing department, we're going to go to an event, we're going to hand out a bunch of gift cards or codes for people to use, and they don't disperse the cards. They just, give them to their family for, as Christmas gifts and that type of thing. Stealing checks, good old fashioned one. Less common today because checks are less commonly used, but certainly was a frequent fraud that would happen. Laptops, mobile devices, and other assets, just simply stealing those. I had one at a public company where it was the manager, one of the engineering managers. This was in Salt Lake City. One of the engineering managers went to the Apple store, bought 10 MacBooks using his credit card, brought them back to the company, put them in a desk, never distributed them to his engineering team, submitted the receipt for the 10 MacBooks, got reimbursed by the company, and then did what we probably would expect in that case. Took the 10 MacBooks out, went back to the Apple store and got a refund to his credit card. Again, just maybe that was $30,000-$40,000, but in the grand scheme of things, just difficult to understand. Payroll fraud, so fictitious employees. Again, when you're growing internationally, not an uncommon one. You really don't know who the employees are in all of these remote locations, at least not initially. And you find out they're either fictitious employees, so friends of real employees, or just totally fictitious employees that are created, and you're paying them. And so one of the tests we would do as auditors, which is kind of an odd test, we'd go through the payroll. We'd select some certain people and we'd send emails and say, can we do a Zoom call? More or less just to make sure you are who you say you are. So lots of different types of frauds, but almost every company that I've been at has had a fraud, and very rarely prosecuted, right? That's the other thing. A lot of these startup companies, they don't want the adverse publicity, right? So someone, rip them off 200K, but they really don't want all of that press, and it's embarrassing as well. You don't really want to tell your investors, hey, we have no controls. 10% of what you funded us, was stolen. Yeah.
That's fine. So
Yeah.
personal expenses and expenses never actually occurred. I feel like the narrative when you create your LLC is you could write off a lot. Tax was used for your personal gain, right? And like you said, with your experience, a lot of people do that. So what kind of makes you want to crack down on certain individuals? Because I feel like it or not, a lot of people do get away with their personal expenses characterized as business study. So what is like the giveaway, I guess, to like what's like the wall that you don't want to hit
In terms of
personal expenses characterized
Yeah.
as business?
Yeah, so really the only thing that should be expensed of the company's financial statements are business expenses, right?
Like you said, they buy G-Wagons, they buy, the private jet trips. So what makes you want to go after certain people?
If I could kind of help frame that a little bit, because I think what Danny's talking about here is I've gone out and I've raised capital, and I have that capital that should be being used for the operation of my business as the entrepreneur, and somebody that I've employed is taking that money and spending it on something that isn't benefiting the business. Clearly, we don't want that. Where I think where your question is coming from is
how founders spend the money.
I'm somebody that I have a business, I set an LLC, so I can deduct on my personal taxes things that aren't really for the business.
Yeah, no, that's a good point actually. So that's something I should have mentioned as well. Is when companies first get started, there is this sort of you have the CEO or the founders, and I actually had one client, and we were having dinner, and he was telling me, he's like, oh, I take zero salary. And I'm thinking, like, it's a startup, right? I mean, that's great, but how are you? You're renting in the, I think he was renting in the Millennium, right? In San Francisco. So that's not cheap. He had an apartment there. And he's like, oh, I just run it through the company. And I'm like, you run it through the company? He's like, yeah, I run that through the company. I run, all my personal expenses through the company. And I'm like, well, now you've created a problem. I mean, fine, you founded the company, so it's sort of, you're not taking a salary. Your issue is you've got a bunch of personal expenses now in the corporate books, and when you file your tax returns, your tax returns are going to be incorrect, right? So you're going to file these tax returns with personal expenses and not just business expenses. So in the end, and I think this is probably to your point, where we ended up with Lucas was, hey, just pay yourself $250,000, $300,000, right? And pay your rent out of your salary, right? It's not, taking zero, you're not really taking zero as your salary because you're running all your personal expenses through the company. So better just to get to right side it, right? So, yeah. So controls, I think maybe the best way to prevent against a bunch of these things are to use corporate credit cards, but keep the distribution of corporate credit cards to a few people. Once you let people use their own credit cards and reimburse those, that's where you introduce a lot of these fraud risks, right? Where people can alter documentation and stuff like that. Having approval limits on ordering, if we're ordering something above $20,000, needs to be signed by the CEO, for example, or the CFO. Putting these limits in place for what can be ordered and what can be paid. One of my clients, he went to work at Salesforce. He was the CFO at Salesforce, and in the high growth period, right, in maybe 2010 to 2015. And he would complain all the time because Mark Benioff would make Graham go through all of the large invoices one by one, right, to sign off on them, right, even though they had automated software. He was so focused on making sure that all of the expenditure was above board, and so Graham would take home boxes of invoices at the weekend just to go through them all. Hire the right people, introduce segregation of duties. That's a really key control. So if you have two people involved in a task, then for there to be fraud, you have to have collaboration, right? Which makes the fraud much more difficult because you're going to have to convince somebody else to commit fraud, right? So segregation of duties is good. Supervisory reviews, having somebody look over somebody's shoulder. Training subordinates so that people can take time off. One of the keys for a lot of frauds is that the person who's committing the fraud never takes any time off, right? Because they can't, right? They have to keep that fraud going if it's an accounting fraud, right? They can't afford to be away for a week in case somebody else does their job and they figure out, hey, these journal entries don't make any sense, right? Having a whistleblower line, it's a public company requirement, right? You have to have a whistleblower, either an email address or a telephone number where people can leave messages. That's where a lot of these frauds are first identified. Somebody will call up, they're anonymous, will call up, and then at the audit committee meetings, the board will go through the whistleblower line that month, and they'll say, we had this many claims, we've investigated these ones are frivolous, these ones don't make any sense, but these ones we're looking at in more detail. But it's very important because you're going to work very, very hard to raise this money, and to have someone, an employee, right, who you've hired and you trust to steal from you, it's very upsetting. I know, like the CEOs that I've worked with at the smaller companies, when fraud is identified, they're very, very angry, right? It's sort of the disbelief at first that someone has done this to them, but unfortunately, it's human nature. One last thing is just cyber risk, and I'm only bringing this up because this actually happened. This happened at two clients. One was just before the IPO. The other one was the company was already public. Spoof emails, from the CEO asking the CFO or someone in the accounting department transfer, this money as soon as possible to this account. Don't ask any questions, just do it, that type of thing. I think we're all a lot better educated now to spot those emails, but you'd be surprised. This is a real example here. So Ubiquity is a company that was founded in San Jose. I was not the audit partner when this happened. I think I'd already rolled off the account, but it could easily have happened while I was there. But fake email to the CFO, who's a great guy, asking for money to be wired. They were doing a transaction. It was an acquisition transaction that was taking place. And Rohit got the email from Robert, the CFO, and it said, please transfer, $14 million to this account immediately. If we don't get it in this afternoon, we're going to lose this deal. And Robert was traveling in Asia. Rohit couldn't get hold of him. Thought about it for a while. He knew the deal was going ahead. You could see the attorneys were also copied on the email. He wired the money, right? And if you're sitting the other end of that and you sent an email and you got $14 million back, what's the next thing you would do? You guys all failed the ethics class, I'm assuming. Yeah. You try again, right? And that's exactly what they did, right? They sent another, I think it was another 13 emails. And so in total, it was $47 million of cash. And it was only when the FBI called Robert and said, hey, your bank account in Hong Kong, there's a lot of activity, what's going on? And of course, Robert was like, what are you talking about? And so that's how they found and stopped the fraud. So whenever I would have a bad day at work, I'd think of the CFO that afternoon. Every company. Yeah. Every company, certainly startups. I would say as you get to be much larger and have more controls in place, it's probably less impactful for you, right? Because you put all of these Sarbanes-Oxley controls in place, which normally involve segregation of duties, supervisory reviews. It's harder. It becomes harder. But every company's affected.
So one of the controls is approval limits on or above a certain or
Yeah.
any kind of
Yes.
transfer. For like your typical seed stage startup, what founders will.
No, that's a good question. That's why I didn't put any number in there. I mean, it really depends. So, I mean, maybe $5,000 is the right number for one company, and then 25 for another, or 50 for another. It really depends on what your burn rate is. Yeah. But I would tend to go lower, right? Lower is better in my mind. I had one client that I won't mention, and they did not have. Maybe we hadn't had the conversation. They did not have a limit on the amount the controller could wire out of the Wells Fargo account. So there was no limit, right? They either hadn't thought about it or they hadn't renewed it, and they raised 500 million, right? And for a short period of time, the controller could have wired that $500 million to a bank account in Argentina. Had disappeared, right? I asked him why he didn't. He said he didn't know about the no limit. No, that was no. He was a good guy. He
I'm
would not do
wondering,
that.
is there a Federal Reserve limit on an amount of a wire?
I don't think so. I think you can wire whatever your terms are with the bank. I would hope somebody at Wells Fargo would have gone, hold on a second, they just raised $500 million. Why is $500 million being transferred to Buenos Aires? You would think, but you can't always rely on the banks. But so this is a good example. This public company, fortunately for Ubiquity, it's a cash cow. It makes so much money. I mean, this was a speed bump for them. So they were able to recover, but it was a good lesson, right, for a lot of other companies. The very bottom one here, this happened to a company that was going public, one of my clients, and they had their source code at a third party where the engineers would do all sorts of testing on the source code. It was a SaaS business, they had pretty good controls at the company, but this third party had no controls. It was a small startup based up in San Francisco. So for about 3 months, a criminal ring had been going in and siphoning off the source codes for every company that used that third party. And so they were getting ready to go public. And then they realized, well, hold on a second, this criminal enterprise has stolen all of our source code, right? And so you can't really go public when your IP has been hijacked. And so it took a few months for them to, figure out the damage. The only good thing about a SaaS business is obviously the source code, your software gets updated every day, right? That's the whole point of SaaS. You're getting the latest version. So having stolen the source code, it's obviously not a good thing to happen, but for the company that stole it, or the criminal ring that stole it, they couldn't monetize it. You'd have to stand up an entire business based on that source code, and then the source code would be out of date, on day two. So it stopped the IPO for maybe a month or so while the SEC, FBI, everyone else got involved to see, what the damage was. But my point is, it's good old-fashioned risks like people stealing your cash, and then also your IP and falling for those scam IP emails. Okay. So this part here, I would have this conversation because I found in my experience that CEOs just didn't like to get involved in any of these accounting discussions, and then they'd only get involved later when they didn't like the outcome, right? And then the CFO would say to the CEO, "But hey, when we were discussing this, you weren't interested, right?" And a lot of times it was because they didn't understand what the implications were. So I've only put 4 things here. There's obviously more, but these 4 things are the key ones, I think, for startup companies. Revenue model, common stock valuation, taxes is a big one, and then key metrics, right? So we'll go through each of those. So I think everyone here is familiar with revenue and where it sits in the financial statements, in the income statement, right? Very first number on the income statement. Some people would argue it's probably the most important number in the income statement. Probably true for startups because no one's focused on profit at a startup. If you're making profit at a startup, you're doing something wrong. You're just not spending the money quickly enough, right? That's what I would tell these companies that I'd be coaching. They'd show me these projections and they were profitable in, year 2 or year 3. And I'm going, if you're going to be profitable in year 2 or year 3, you don't need to raise 25 million. You need to change these projections so you have great big whopping losses in year 2 and year 3, But definitely one of the most important numbers, it really tells you about the health of the business, because you can compare the revenue for this year with the revenue for last year or the revenue for the year before, and you can see if the business is growing, right? A healthy business is a business that grows, right? So definitely important for that aspect. It does drive valuation. So I don't know if you've done enterprise valuation classes yet, or looked at how companies get valued. But one way they do get valued is as a multiple of revenue, right? So let's say you started a SaaS business, private company, and you have revenue of $10 million. And you're trying to figure out what the business is worth when you're sitting down and having a conversation with the venture firms. You could go and look at all the SaaS index for public companies, and you could see that maybe they're valued based as a multiple of 8 times revenue, right? For public companies. So you can use that multiple, and you'll say, my revenue is 10. I'm using my industry multiple of 8. Therefore, my business is worth at least 80 million, right? So it is important because it does drive valuation as well in some cases. And if you're a public company, it's really important because there's 2 things you have to tell the street, right? One is, what's my revenue going forward for next quarter, for the rest of the year? And what's my earnings per share, right? So if you look at any press release, 2 things at the top of the press release are revenue was X, EPS was Y, right? So very, very important number. And there's a lot that goes into revenue. It's quite a subjective number. I would always say, pick your revenue multiple or your revenue model very carefully. There are different models, right? So here in the Valley, if we think about how software is sold, there's a software as subscription, so SaaS, right? So it's basically a service. The company owns the software. It's letting you use the software as a service, right? You would access it online. If you think of an antivirus software that you might be using, right? You're using it, gets updated every day, but you need a connection with the server of the company to be able to use that software. So it's really a service they're providing. That's a very ratable model. I sign a contract for a year, and let's just say the annual subscription is $365 for a year. That company will recognize $1 every day, right? So as soon as you sign a contract, the company knows how that revenue is going to roll out. So it's perfect if you're forecasting it and you're a SaaS business. Life is so easy, right? As soon as you sign a contract, if it's a 1-year contract, 3-year contract, 5-year contract, you can just model the revenue. It's ratable, right? It's X dollars every single day, right? Typically, right? I'm simplifying it a little bit, but that's perfect as a CEO, and I'm facing the street. I would like a ratable model, because then I can talk to the street about, hey, my revenue for this quarter is X. Next quarter it's going to be X plus 20%. Very easy to project. Takes a lot of stress out of projecting revenue. So maybe I want that, right? That could be good. The problem with the ratable model is when you get to the last day of the quarter or last week of the quarter, and you're going to miss that quarter's revenue goal, there's really not a lot you can do. You can sign all the contracts you want, but you're only going to get 1 day or 7 days of revenue from that contract, right? So it kind of puts you in the flip side of that is you've got little flexibility, right? You can't really move the needle very much if you need to. Hopefully you don't need to. You've done a good enough job planning the revenue. So you can have a licensing model, which is the opposite. So I'm just going to license the software to you. And then I can move the needle, right? I can go out and sign 10 new licensing agreements on the last day of the quarter and deliver the software, and I'm done. I've got all that revenue. But it's much more unpredictable. So those two extremes of models. One other example I would give you is I've called it here sort of for platform and marketplace companies. So there's this agent principal concept. So am I the principal in the transaction? So am I responsible for everything? Or am I just an agent? And we'll look at DoorDash as an example, and I'll explain that a little bit better. But that's really, do I record the high amount of the revenue, the gross amount, or do I just record the net amount, the amount I'm left with, right? So obviously you get two very different numbers if you do that. And you may say, well, obviously I'd always want to record the gross amount, but not if you have a very high revenue share arrangement with a partner, right? Because your gross margin is going to be much lower on the gross amount. But we'll go through an example. So revenue is not, it's actually a lot of subjectivity that goes into the model that you pick. And so if you're the CEO, you need to be sitting at the table there, right? Having that conversation with the CFO, the accountants, the auditors, the board. Here's the revenue model we've chosen, right? And here's why we've chosen it. You can't come back, as you're getting ready to go public and say, hold on a second, it's too late then. Also, it plays into commission strategy, right? So that's going to affect your commissions, your IT systems, export controls, the terms and conditions you're going to have that you're sharing with customers. So, so here we are. Maybe it's a bit unfair to put pizza up here this early in the morning, but I'm going to demonstrate this gross versus net model, this principal versus agent model. And so you'll see that there are a lot of companies that have this model, right? So this is Pizza Hut, right? So this is just the old way of how we account for revenue here. So we order a pizza, it's $28.09, pay by credit card, right? We've all done this. For Pizza Hut, they will record the entire amount. That $28.09 is revenue, right? And they'll record it when the company has met its performance obligation to the customer. That's big language for what did I tell you I was going to do in order to earn this revenue. And for Pizza Hut, you can see here, they say on delivery, right? They've done everything they said they were going to do. You called up, you ordered a pepperoni pizza. They told you they would deliver it to your house. As soon as they've done that, they're all done, right? Whether you like the pizza or not, it's a different issue, but they can record the $28 as revenue. They get the whole amount, right? Their revenue is $28. So that model changed with DoorDash. So I'd said DoorDash was my client when they first got started. One of the things they made us do was we actually had to do a delivery ourselves, right? So we took an order as the auditors. We took an order. We went to the restaurant. We waited. We picked up the food. We delivered the order to the to the customer. And so I actually did have to get pizza. This is in Palo Alto. I got like 4 or 5 pizzas. And I went on to DLA Piper. It's a big law firm. I don't know, maybe you see it as you drive up the 101. And so I was there with the 4 pizzas at reception. And I knew a bunch of the partners at DLA. And they're like, what the hell are you doing? I'm like, the whole PwC thing just didn't work out. So I'm delivering pizza now. And they were good tippers, I have to be fair. But with DoorDash here, you can see it's a different model. So the customer gets billed the whole $25, right? But DoorDash, when you read their performance obligations, and that can be in a contract, can be in a purchase order, an email, or for them, it's actually on the website, their T's and C's. So it looks like this terms and conditions agreement. What do they say they're actually doing, right? They say they're providing a technology platform, right? It's connecting you with independent food service providers. We would call those restaurants, right? It's connecting you with a restaurant and with independent third-party contractors who provide delivery services. That's the driver or the dasher, right? DoorDash is not in the delivery business. So they're telling you, we've got nothing to do with the delivery. All we're doing is connecting you with that driver. We're not driving it. DoorDash provides a technology platform, facilitating the transmission of orders, and they tell you they're not responsible for the food, right? So right away, we all think of it, it's a kind of this circle that's unbroken, right? It's DoorDash. They're taking all of our money. But no, if you read their terms and conditions, they're saying all we're doing for you is we're connecting you with the restaurant and we're connecting you with the driver. Yeah. Wash our hands after that. We've done everything we said we'd do once we've done that. So this is from their financial statements. So they're acting as an agent, right? So they're an agent for you and an agent for the restaurant, for the driver, right? They're not the principal. Pizza Hut was the principal in the transaction. So this concept of do I want a principal model or do I want an agency model is very, very important, right? And you have to make sure your terms and conditions line up with whatever you're saying the model is. And it's very easy to change terms and conditions to say we're not responsible for this or we are responsible for this, and you get a totally different accounting answer. So when we were working with Uber, when they first got started, they had an agency model from an accounting point of view, but when we looked at their terms and conditions, they would have suggested a principal model. And so they had to change their terms and conditions to come into line with the agency model that they wanted, right? Otherwise, they would have had to record the full amount of the revenue and all of those costs as cost of revenue. So it's very important to get your terms and conditions or your contract lined up with the accounting that you want. And you can see you can get very different results. Let me just finish the DoorDash example here. So here's our bill. So DoorDash doesn't keep the whole $25 as we know, right? So the DoorDash gets a fee. That's their revenue, right? They'll hold the sales tax and pay that over to the sales tax authorities. So that's just a pass through, right? Nobody gets that other than the franchise tax board. The driver is going to get the delivery fee and the tip, and the restaurant gets the subtotal less their commission, right? So that $25 gets carved up. And so if you look at, this is from their IPO document. If you look at their disclosures, if they were the principal in the transaction, their revenue for 2020, which is the IPO year, the year before the IPO, would have been $24.7 billion, right? As the principal. But look at what the revenue actually was, right? Because they're agent. So the revenue as the agent is $2.9 billion. Okay? So if you change a few terms and conditions, you would have revenue of $24.7 billion. But obviously they're an agency model, so their terms and conditions, they're just connecting you to these different providers. So they end up with 2.9. So you may again ask, well, why wouldn't I go for gross? Because you told me, value of the company can be based on revenue. So the reason for that is if the revenue was 24.6 or 24.7, then their cost of revenue is going to be 21.8, right? They're going to have a 10% gross margin. They don't want a 10% gross margin business, right? Who's going to invest in a 10% gross margin business, right? So sure, I could have the higher revenue, but I'm giving it all away, and in cost of revenue, it's going to the restaurant, the driver, and I'm left with just this very small commission. So they would rather have this lower revenue number, but a much higher gross margin, right? Because the business, no one's going to value this business based on that gross revenue number. Not when 90% of it's going out the door, right? At the very same time, right? They're going to get valued further down the income statement. It's exactly the same reason. If you look at Apple's financial statements, they break their revenue into product and service. So service is a lot of the app stuff that we buy. Apple have structured their terms and conditions so that they keep 30% typically of the dollar that you'd spend for the app. They'll keep 30%. They've structured their terms and conditions so that they are an agent in that transaction. Even though you're going through their ecosystem, to download the app, and you're using your Apple ID and it's on your iPhone and everything else, the way the terms and conditions are structured is their revenue is just the 30 cents on the dollar, not the dollar. And the reason for that is Apple doesn't want a 30% service business, right? A dollar for revenue and 70 cents of cost of revenue and 30 cents as gross margin. They don't want that 30% gross margin business. That's way lower than their products, right? So now if you look at their income statement, you'll see their margin, because they start with the 30% or the 30 cents as the revenue number. Their margin in that service business is probably about closer to 80%, right?
I have a question.
Sure.
You make it sound that it is extremely easy to change a few words in the terms and conditions and get to a completely different outcome.
Yeah.
But in one of the scenarios, we would get like double counting of the service. Like both the restaurant and DoorDash would keep me recording. Like the restaurant would keep me recording $20 and DoorDash 25.
Yeah.
Like how is that?
Well, there is no global double entry bookkeeping system, right? Yeah, it doesn't matter.
But isn't this indicative that the prior before you suggested the change, they were just misreporting?
For the example I gave you, where the terms and conditions didn't line up with what they were recording.
Like you suggested it previously, they were recording their terms and conditions and the principal.
Yes.
Yeah.
Yes. So they were a private company at that point. So, and if they hadn't been audited, we were the first auditors. So when we first came in, yes, their terms and conditions would have suggested you should record the revenue as gross. But that was one of the first things we fixed, or they fixed the terms and conditions. Yeah. Yeah. So the point here, I mean, it's a little bit of a convoluted example, but you think of DoorDash, think of Airbnb, think of Lyft, think of Uber, think of Instacart, think of eBay, think of Etsy, think of Poshmark, think of all the learning platforms. They all have this issue, right? They all have this issue. And I would say most of them are probably on net. I can't speak for all of them, obviously. You can find out if you go look at the financial statements, you'd be able to dig through the notes. But
Danny, just speaking from a guy who wants to order a pizza. So
Yep.
again, I order pepperoni. And then get the pizza and you're the driver.
yeah,
You ate all the pepperonis off my pizza.
Yeah.
When I opened the box. So technically I should be running down the street after the driver at that point.
yeah. No, that's a really good point, because that was actually one of the things. It wasn't for DoorDash specifically, it was more for Uber. One of the things the SEC came back with and said, but if if there's an issue like that, and DoorDash ends up stepping in and refunding the diner, or giving you your money back, and you still got a cheese pizza, right? Right. So they did. Yeah. So it's. I know this is where it's sort of substance over form, or maybe form over substance. So as long as your terms and conditions say that the driver's responsible or the restaurant's responsible, it's okay for you to exercise your discretion, right? And maybe step in occasionally. So what would happen is that driver would probably get kicked off the platform, right? They don't say that. No, they don't say that. But what they will do is they'll root out bad players, and so they don't have that issue, so it's not a repeat issue. And I don't know, like maybe you haven't used them long enough, but I've definitely noticed when I first started using them, they've gotten a lot stricter, right? And I could see it. They've gotten a lot stricter about refunds, and that's part of the issue, right?
I reckon it would become a matter of materiality that if that happens a significant amount of time, the
It would be,
expectation
yes.
they'd put an allowance
That's a good point.
for
Yeah,
potential.
that's a good point. Yeah. Oh, they definitely have allowances They definitely have allowances. Yeah.
Oh, so they
They'll-
recognize an expense for the potential.
They'll have allowances for sort of customer accommodations, right? Definitely, yeah. But if it became so pervasive, it would threaten the whole model, right? Yeah. So this one's a very important. Obviously, revenue is incredibly important. You get the right model, everything stacks up, everything lines up, looks correct. You can defend it. The next one is common stock valuation, and the reason that's important is you're using it for compensation, right? So all those stories you've heard about, people becoming multimillionaires overnight in Silicon Valley, it's not through their salary and their bonus, right? It's all through equity compensation, right? And so it's a key component here. Once you get further outside the valley, it's less of a compensation element, but here it's still very, very key. Whether it's the stock option that you get, or whether it's some restricted stock units that you're getting, it's a very important part of your compensation strategy. You're going to make your decision which company to join on a number of factors. This is going to be one of them as well, right? When you're looking at your offer letters. So it is central to hiring and wealth creation. It's got incredible favorable tax treatment, right? So stock options. We won't get into stock tax and stock options, but essentially you've got this wonderful tool where you don't get taxed on it until, in most cases, until you actually sell the stock, right? So you could have it for years and years and years. It's growing constantly. You're not being taxed as it's increasing in value, and then you can sell it, pay your tax, or you can sell the stock, or maybe hold the stock for a year, sell it at capital gains, get favorable tax treatment. So it's an incredible compensation tool. Very fortunate. But there's a lot that goes into this, right? So to get those favorable tax rules, you have to issue these stock awards at fair value, right? And so what fair value means is, for all intents and purposes, you have to go out and get a valuation firm to come in and tell you what the fair value of the stock is, right? And so if you don't do that, you don't get any of these tax accommodations. So it's very, very important. These are called 409A valuations, just the code, but that's the terminology, a 409A valuation. So when you're going out and getting hired by companies or going for interviews, you can, by all means, you can ask, what the last 409A valuation was. They'll know exactly what you mean, and hopefully they'll share that information with you. You could better informed to make your decision. But you have to get this valuation done by an independent valuation party. In the good old days, you could just come up with the value yourself. When I first got here, the board of directors would go around the table and go, 10% of preferred stock seems right. That would be massively low, and they would issue these stock options at these very low exercise prices. So the CEO needs to be part of that conversation, right? You can't delegate that to the finance team. You need to be sitting around the table when you're having these conversations, because I'll show you how companies get valued. Needs the input from the founders and the senior executive. And then there are things in business that can change the value of equity. So if I signed a contract with Microsoft for $100 million tomorrow, the stock tomorrow is going to be worth a lot more than the stock today, right? So you're constantly looking at things that could impact the value of the business, signing new contracts. even if someone gives you an offer to buy the company, that might be a relevant data point for the value of the company. That's on the positive side. Negative side, if you lost a huge contract, you know, that's gonna have an impact on your stock price, but obviously a negative impact. So sometimes the CEO is the one that's aware of most of these things that are going on. When you issue stock to an employee, it's non-cash, obviously. There's no cash involved, right, until the employee exercises the stock award and pays you cash to get the stock. So what you get is a stock option. And an option is literally an option to buy the stock at a certain price. Those stock option agreements are normally 10 years in length. So you have 10 years to decide, assuming you're at the company for 10 years, you know, should I buy the stock at $5, right? Now, if the stock is trading at $50, then yes, you should probably exercise that stock option and buy the stock at $5, and you have a $45 profit to think about. There is an accounting cost that comes with issuing these stock options, even though there's no cash involved. There is a value to the option, right? And that value is calculated based on a model, typically a Black-Scholes model, and it will look at these things like the underlying stock price, the exercise price, which is the price that you can buy the exercise of the option at to buy the stock, how long you're going to hold the option before exercising it, some stock price volatility, risk-free interest rate today, dividend rates. So basically some modeling that needs to be done. And there's tons of models that are available. I just threw this one together just to show you how you can change. So we have an example here. I'm a private company, of course, right? This is, we'll assume a private company. I have a value of $10 on my stock, right? That's what everyone thinks it's worth. I'm going to give you an option to buy the stock. I'm going to set the strike price for that option at $10. That means you can buy the stock at $10. I think you're going to hold that option for 6 years. That's pretty typical. A lot of modeling, 5 to 6 years tends to be the period that people hold stock options. I don't pay dividends, so my assumption is zero dividend. I'm going to assume some level of volatility, and I can pick that volatility level from public companies that I think I compete with or I'm similar to, so 50%. And risk-free interest rate's probably higher now, but let's say 1.5%. I push the button, and I have to record an expense of $4.84 for every stock option that I gave you, based on those inputs, right? And I would recognize that expense over the vesting period of the stock option, which is typically 4 years, right? So you earn these stock options over 4 years, or the restricted stock units over 4 years. So I have an expense, and that's if you look at tech companies' financial statements, you'll see the biggest expense item is stock options. It's enormous, right? Hundreds of millions of dollars, right? And as they get to go public and the value of the stock increases, that number gets bigger and bigger and bigger. It's non-cash, right? It's an accounting thing, but these are gigantic numbers.
Yeah, I'm sorry.
Yeah.
What I see is compensation expense.
Stock-based compensation, yeah.
Well, I'll see compensation expense on the income statement, which I'm assuming is cash and this number.
Yeah, you typically won't see compensation expense on the income statement, right?
When you go to statement of cash flows.
When you go to the statement of cash flows, you'll see this stock-based compensation expense. And the reason it's in cash flows is because it's a non-cash expense, and the company has to add it back in the cash flow statement. So the place to see it, there's two places really. One is cash flow, and then the other one is in the statement of stockholders' equity, right? So when you record this expense, it's debit stock-based compensation, debit operating expenses, credit additional paid-in capital, right? So there's two places you can see it.
So where I was going with the question, sorry, is do they disclose that anywhere else? Is there a footnote disclosure that would speak specifically to the portion of compensation expense? I know it's on the statement of cash flows as an add back, but is there somewhere else?
Yeah, there's a big there's generally a very large footnote on stock-based compensation. So it explains a lot of these assumptions. It should talk about the volatility, the risk-free interest rate, so you can see how they've modeled it. And so, sorry, the only reason I wanted to show this to you is just to show you how, by changing some of these assumptions. So there was our 484 was on the right-hand side. That was the one we looked at. And so you can perfectly, it doesn't, I'm not saying one is right and one is wrong, It's very subjective, so it depends what you think is supportable. So here, all we did was extend the time to maturity by a year, and we upped the volatility. Maybe we're in a very volatile sector to 90%, and see the difference, right? So now I've got, for every option I issue, I've got an extra $3 of compensation charge. So that's why the CEO needs to be involved in this, right? You can't wait until it's the IPO and go, hold on a second, why do we have these hundreds of millions of dollars of stock-based compensation? And that happens, right? I've been in meetings where it's like the light bulb went on, right? And I feel like saying, like, where have you been for the last 4 years? Obviously, I would never say that because I would lose a client very quickly. I'm generally a bit more discreet, but you can see if you're not at the table, all this stuff is happening, right? You're focused on engineering, which is fine, or you're focused on product fit, or looking at that market study. That's fine as well, but you need to be in the meeting, right? The CFO needs to call you and say, "Come in. We're finalizing the 49A report. I want to make sure you're comfortable with, with our
What is the
assumptions."
volatility of the price?
Yeah, how the stock price will move, right, over that time period.
Isn't that seem counterintuitive that if the volatility is higher, the stock, it seemed like.
Depends on the industry, right? Depends on the space. So where you'll get that number from is you'll go, let's say, I'll pick on SaaS companies again because there's tons of them. I would go to a bunch of public SaaS companies that I think maybe I'm doing customer relationship management. I go pick Salesforce, a couple of others, and they have a volatility of 90%. I'm going to use 90%, right? As a proxy.
It seems if the price is more volatile, the option would be worth less because it could go down, it could go up.
As you increase volatility, the call price option will increase. Yeah, will increase. And as you increase the time to maturity, the value of the option increases too. Those are the two things. That's what I wanted to demonstrate there is just by changing those. I mean, I change one a lot, obviously, but it has a major impact. And it's very subjective, right? It's very, very subjective, but you have to be able to support it because the IRS can come back and say, hey, we don't necessarily agree with, with those numbers. So if you have a valuation report and you document everything, which is what happens, then you're generally on safe ground. Okay, so obviously one of the inputs in here was the current stock price, and so that's basically the value of the company. And I'm sorry, yeah.
Maybe a little bit of a tangent, but the time to maturity.
Yeah.
Like, I feel like all of these decisions are important when you're trying to attract talent.
Yeah.
Create a good incentive structure. Time to maturity would be like increasing that would be more expensive for you as the company.
Yes.
Is that more attractive to an employee?
Well, employee would want the lowest possible price, right? So employee will want the lowest possible strike price. I don't think the employee is going to be too concerned about the stock-based compensation charge in the income statement.
Okay.
Yeah. Yeah.
Okay, so time to maturity, that's not like when they can exercise it.
No, that's your assumption about the whole pool of options that are out there, how long people are going to hold the option, right? Yeah. So remember I said 10 years is the max. And so no one's gonna sell the option before the first year because you actually cliff vest at the end of 12 months. So if you left on day 364, as opposed to day 365, you would leave behind all of the options you'd earned for the first year. So it's going to be somewhere between 1 and 10 in terms of when they're going to exercise. And they come in different tranches, right? So you don't have to wait to exercise them all at once. As soon as you vest, you can exercise. Yeah. So 6 is just kind of a default of, between 1 and 10. Yeah. Yeah. Or 7, I think, in that case. Oh, sorry. Yeah.
Right, and I know that NVIDIA has a big compensation with stock.
I'm sure.
Like,
Yeah.
why does that make sense for the CEO who has big goals for the company to get the stock price up?
Yeah.
Why are they giving away stock or
Yeah.
cash? I know
No, it's good.
cash is very important, like a big company like
Yeah.
NVIDIA.
Yeah.
Like a little bit of cash for stock, like,
So
why does that make sense?
yeah, so it's a really good point. When we get to key metrics, I'll show you an example there. This stock-based compensation number, so that's 778. That doesn't involve any cash, right? That's just purely debit operating expense, credit, statement of stockholders' equity or credit, additional paid in capital. When they report the results, a lot of companies will just add back the stock-based compensation charge, right? Like pretend it didn't exist. So a lot of public companies, when they disclose their results, you'll see they'll have something, they have the GAAP results, and then they'll have something called adjusted GAAP. And in adjusted GAAP, they take out the stock-based compensation charge. And the reason they do that is they say it's not cash. So we want you to ignore that because even though it's included in our net profit or net loss, it's not a cash item. So we're going to set that aside. Yeah. So when I first came here, no one booked this. The accounting rules, there was no recognition for the value of a stock option, right? And people have been saying for a long time, well, that doesn't make any sense because, I mean, if you equated that in cash, you would book something, right? And it's very valuable. You can see it's worth millions and millions of dollars. And so they came up with this accounting model about how to value the stock option, right? And so you still have some legacy left over where people are like, you know what, we never used to have that. It's just something the accountants get excited about. So we'll book it, and then when we show our results, our non-GAAP results, we'll take it out and we'll talk to the street absent that number. So
Two questions. I'm sorry.
yeah,
Well, let me ask the second question first. So you're telling me the SEC lets a company say, SEC, you recognize Financial Accounting Standards Board, the standard setter. They tell us how we're supposed to account for something.
yeah,
And then they also let them go out to the public and say, never mind what SEC and everybody else said we should be doing.
yeah.
Here's something else you should look at. And
Yes,
that's
no,
okay for
yes.
them to do that.
Yeah, no, it's. I mean, there are some rules, but yes, there's companies can disclose non-GAAP financial statements, and so every press release, if you pull up a public company press release, you'll see GAAP. There are some rules. So the SEC, you have to show GAAP first. You have to give GAAP prominence, right? So GAAP comes first, and then when you scroll down the release, you'll see the non-GAAP, and so they can do. There's certain things they're not allowed to do, right? But there are certain things they can adjust for in non-GAAP. You have to make it very clear. And then once you've done that, you have to reconcile the non-GAAP number back to the GAAP number. So they're kind of admitting defeat on the one hand, right? But you have to, we'll let you do it, but we want you to sort of reconcile it back to GAAP so that everyone's clear.
That's annoying.
Yeah, no, it's actually a lot better than it was.
From a
It's-
fact,
yeah.
from a educator standpoint. But then the other question, these options, the stock that you would get when you exercise the option, can you speak to the voting? Because I think part of the question is I'm giving away stock that I could be selling in the market.
Yeah.
Way,
Mhm.
way more than the cash of the
Oh, yeah.
company. So it's like,
Way more.
why is the CEO giving someone like literally millions?
But it's not a company expense when you think about it, right?
But so no one listens.
Well, it's whoever bought.
Is it from the same shares that they're authorized, or is it another set of shares that they're?
No, these are the authorized shares. Yeah, so whenever you authorize shares, you include the equity option plans in there. And I see your point. It's not. I see where you're going. So let's just say, I'll give you a good example. I won't use names. Right? Someone used to work for me, and he was. We wanted to say become a partner at PwC, and he decided he wanted to do something else, and he is worth probably 300 million now. So it was a good decision. Now he has 300 million worth of equity, right? And he sold a lot of it, right? But it's not an expense to the company, right? The cash is whoever buys the equity from him, right? So, yeah, if I bought some of their shares from him, then I'm giving him the cash, right? So to the company, it's a non-cash expense. It's whoever ends up buying the equity. Yeah. So the company wants to give a lot of equity out as compensation, but don't too much because you don't want to dilute. You don't want to dilute your shareholding too much because remember that little thing, earnings per share. You know that's your net income divided by your common stock outstanding. If you have too many shares outstanding, the denominator, your EPS comes down. If your EPS comes down, people start getting concerned, right? So dilution's important, but the example of rewarding employees, I know a couple of NVIDIA guys used to work at the firm, and yeah, it's a lot. Oh, I don't know.
I think it is.
Oh, Yeah, I don't know. When I came here, there was we had this whole story about Cisco was our client. And I worked for the partner who actually got the Cisco accounts in the early 80s, I think. And his name was Larry. And so Larry used to tell me, we'd go out to Cisco and he'd point at the receptionist and he'd go, 10 million. And then he'd point at the janitor, 3 million. And he'd point, I'm like, stop, you're depressing me. This was in the 90s, right? But yeah, depending on, it's all luck, right? Depending on when you join, and a lot of it is luck. I don't want to say it's all luck, but a lot of it is luck. I just wish I was that lucky. But it's a great tool. I mean, it really is. We can have a separate discussion about whether you deserve to have $20 million for just doing your job, your normal job, while other people don't. So 3 ways to value a company. One is discounted cash flow, or DCF. So it's also called the income approach. And so you do your forecast of what you think your income statement's going to look like for 5 or so many years. So it's cash flow, right? It's all based on cash flow. You discount it back using whatever your discount factor is, and you'll end up with a value here. So 12 million. So this is when you do that 49A report, the valuation company will ask you for a DCF model. And so you'll sit down with them, the CEO, CFO, sit down with them, put all of these numbers together, and then it'll come up with this enterprise value. And that's what gives you the stock price, right? That $10 that we looked at. So you can see there's tons of assumptions in here, right? Everything in here is a massive assumption, like revenue, right? Revenue growth rates, earnings, all of this stuff, right? So you need a good finance FP&A team, financial planning and analysis team, to put these things together. A lot of startups won't do this because they don't have the sophisticated FP&A team to put together a set of projections that really holds muster. So that's one way. As you get further up the funding chain, you're probably going to use income approach a lot more. Market multiples we already talked about, right? So that's another way. So you find your public company comps, and this one's based on enterprise value of sales, based on sales. And so for all the companies they think they look like, they're saying our multiple is 2.2 times, their multiple is 2.2 times sales revenue, 12.9 times EBITDA, so earnings before interest, tax, depreciation, and amortization. So you'll find a multiple more common for startups, much easier, right? Because you know what your revenue is, and hopefully you know who your peers companies are, and you use public peers, and you can go get that data very easily, right? It's very easy to get it. This one's very simple. Sometimes you would use forward sales and so forth. So, but here, if our revenue was 10 million, we would say we'd use 2.2. We'd go to the VC firm and say, hey, we looked at all of our public peers. They're trading at 2.2. Our revenue's 10 for next year. We want to raise money at 20 million, right? Or 22 million. And then the last one, again, this is remember, our goal here is to come up with the common stock value for the company. The last one is basically, and the best one, most reliable, is if you can use a financing round that you just closed, right? So in this situation, we just closed a $5 million round. We gave up 20% of the company for that $5 million. Therefore, the company must be worth 25 million now after the funding. Okay. So I would say in the order in which I've seen them, the earlier stage companies, if they've got a recent round of financing, they'll use that to determine the common stock valuation. If they don't have a recent round, they'll use market multiples. And then finally, if neither of those apply, or they think they're probably going to get a higher value, they'll use DCF, discounted cash flow, or some combination of those. Quite often, I would see them being weighted. So they would do all three, maybe gave 50% DCF and 25% to each of the other two, and come up with a blended. So you can see it's very subjective. But again, you need to be involved in that, because look at the repercussions. It's going to drive what your stock option price is. It's going to drive what your stock-based compensation numbers are. So you can't just wait until, it's too late to get involved in these conversations. I mean, a good CFO should involve you, right? So the CFO should have you at the table, and you should be having these conversations with the CFO. It's all back to hiring, the quality of the hire that you make. But if I was CFO, I would have the CEO with me at all of these things, right? And how are we doing for time, Professor Lord?
We are
Speed up.
pretty good. Supposed to get out at 11. That's the official time.
Okay.
I'm getting out at about quarter till.
Okay, well, I'll go fast on this last one then. So, taxes, this is really important, so please don't fall asleep. I know whenever I hear taxes, I'm kind of like, my head starts nodding to one side. Really the biggest area, the most neglected area for startups. And why is that? Because I'm not making any money. I have these huge net operating losses. I'm not going to pay any tax. Correct, you're not paying any income tax. But it would be a great world if it was just income tax and we could ignore all the other taxes, right? And so this is the biggest pitfall. Affects every business. So I'm going to talk about a couple of things here, but really sales tax is the big one. And then withholding tax is the next one. And then I'm going to talk about tax issues coming up on due diligence. So let's go through these. I'll try and go through these quick. So I guess I'm doing it in a different order. Let me see if I can find okay, that's fine. Maybe that didn't come through. So sales tax. If you're a business and you're making a sale in another state, even if you don't have any facilities or people in the other state, right? The tax rules change quite significantly. Generally, you are required to charge sales tax in those states, right? Which means you need to be registered in those states and withholding sales tax and then passing it on to the relevant tax authority. This is the biggest mistake that startup companies will make. They won't get registered in these different states. And then the problem festers, it compounds, and the penalties are enormous, right? Because it's all the cumulative tax that you haven't paid, plus the interest, plus penalties. And you can end up with these very, very large liabilities that are unrecognized, and typically you'll find out about them when you're meeting with auditors for the first time, and they're like, so how many states are you registered in for sales tax? And you see this blank look on the other side of the table and you go, oh God, we got another one. It also comes up, I put this up because I thought this is Plant Moran, it's from a consulting firm. I think they captured it really well. Due diligence reviews, whenever I go in and on behalf of a client to look at another company they were thinking of acquiring, I knew the first issue I would find would be sales tax issue, where they hadn't registered in states that they should have registered in. And then what we would do is do really quick back of the envelope calculations. We'd use the maximum penalties, we'd use the maximum rate of interest. We'd go to our client and we'd say, I know you were thinking of paying 50 million for this company. Look at this sheet of paper here. There's a $10 million tax liability in 23 states. And so they would then go back to the company and say, hey, let's just hold off here. We're not paying 50 million. We'll pay 40, right? And so it has a massive impact. So if you had just had a conversation with a tax partner for an hour for $1,000, let's say, you would have avoided that entire issue, right? It would have saved you hundreds of thousands, potentially millions of dollars, right? Just that one conversation. Which brings me on to another example here. So that was sales tax. This is withholding tax. So a lot of those platform companies that we talked about, those marketplace companies, a lot of education companies, I think this is Udemy, they use creators and third parties to provide a lot of content, right? If you don't get your tax forms lined up properly, i.e. you need a form from them, a W-9, which basically tells them what their tax identification number is, and you get a 1099, which is a document from them saying, hey, company, I'm a subcontractor. I'm responsible for my own taxes. You don't have to withhold any tax. If you don't get those, then the IRS says you are responsible for all of the tax that person should have paid. We're going to deem them to be almost like an employee of the company. And so imagine you have thousands of creators or content providers, subcontractors that you're using, and you haven't got that paperwork. So this is a real example here. So for this company, we were in a meeting with them talking about the audit, and we asked that question about, hey, did you get all the W-9s? And 1099s and there was just this blank deer in the headlights look. And so we knew right away that they had a massive tax issue, and we actually switched from the audit to be the tax provider to help them through the issue. And so it was $17 million was the liability, right? And again, maybe an hour, 2 hours with a tax professional would have saved that. And so that's my point about, you need to get ahead of these issues, particularly on tax. Some other issues, this is an older one. Again, I won't go into the detail on this one, but they probably didn't exercise the right amount of diligence when they were thinking about how to structure the lockup agreements for some of these employees on an IPO. This one's on Stripe, where I said 10 years for those option agreements. Well, they didn't have a liquidity event within the 10 years. So they had a major issue with a ton of employees getting to the end of that 10-year term, but no market for the stock, right? And so that's a separate issue. So a little bit of tax compensation there. But again, these are things that, as the CEO of the business, we really need to get ahead of these. I'm going to rush through these last ones so you can get out on time. So there haven't really been many IPOs recently. So the IPO market is dead, right? I know we had CoreWeave in March. But not a lot of tech IPOs, right? The IPO market's really bad. It'll come back, but typically you need to be sort of at a position where you have substantive revenues, a good growth rate, predictability. I talked about that really helps. No point in going public and then getting trashed for the next 20 quarters, right? Or your stock price is in the toilet, right? Which has happened to a lot of companies that went public too soon. Need to be, if not cash flow positive, at least maybe on the path to cash flow positivity, and have something unique about your value proposition, obviously. So I sort of trivialized that. It's actually quite difficult to get ready to go public. It's a long time scale for going public. You need to plan well in advance. As you get closer to going public, this is a good checklist. Corporate governance, independent board I talked about, putting these committees in place, upgrading all the systems, upgrading the management team. You'll see, if any of you have any experience with companies that have gone public, the management team changes over radically, right, in the 12 to 24 months before an IPO, and maybe even the 12 months afterwards. Because a lot of the people that got the company to 100 million, 250 million, they're not the people that are going to get the company to $1 billion, 2 billion. And so the team will change, right? And so you need to find those people and plan ahead. And then obviously it's a very expensive proposition as well. Here's the IPO market. So the IPOs are the burgundy colored ones. So these are basically the public listings. The burgundy ones. I ignored the other SPACs and so forth. So you can see, I actually retired from the firm in 2022. So I don't think this has got anything to do with me retiring, but I just think it's coincidence. But the market's gone, right? I mean, there's just no IPOs. And the problem with not having any IPOs ends up being a venture problem, right? Because the venture capitalists, they can't return the money to the investors, to their investors, right? So institutions like this, pension funds. So when a company goes public, that's an exit. They sell the stock, and then they return the stock. They return the cash to the limited partners, right? The investors in the venture capital fund haven't been able to do that, right? And so what that means is it's much harder for them to raise money, right? Because those institutions have not had the distributions from the venture firm. So it's kind of this vicious cycle that we're in. If you're a really good VC firm, it doesn't matter, right? So they're not too far from here, right? Could probably name 10 of them. Not too difficult for them. It's still business as usual. They're still going to be able to attract capital, right? And they're still going to be able to deploy that capital. It's maybe the first time managers that are having a really hard time raising capital. Key metrics. I'll just speed through this. So this is DoorDash. So you can see these are not GAAP related. They track the total number of orders. Marketplace GOV is that total credit card transaction number that we saw for them, the $25. And then they have some, I have to be careful here. I'm being recorded?
Yes.
Okay, some non-GAAP numbers here, contribution loss, which they've defined, and adjusted EBITDA, which they've defined. And so this is what they report to the street. So you have to pick key metrics for a business. You can't change them once you pick them just because they go south, right? So you have to pick them really carefully because you're going to have to live with them forever, like GAAP numbers. And so you can see their total orders, they're showing really, really healthy growth in millions. And this is their IPO stats here. Marketplace GOV growing nicely. There was our 24.7 billion that we looked at. And then they're showing in this contribution profit loss, they're showing they're going from a loss to a profit that a profit measure that they've defined. They basically define all of these, and as a business, you would have to do that. And so here we can see this is what it looks like to the investor. This would be part of the press release, press reward. So this would be, they'd have all the GAAP stuff up here at top. And then when you get to the bottom, you'd have all these key metrics, right? So you can see how they're doing on a quarterly basis. So again, you can't ignore the GAAP stuff. But you also have to think about non-GAAP, like what makes sense for my business. Should I show total customers greater than $100,000 in revenue? Is that a key metric for me? But you have to define those very, very carefully. And then I think just to finish up, when I look back and I think about things that could have been done differently, I would say this underinvesting in the accounting and finance organization, leaving it too late. And you can see, from some of those tax issues, how expensive that was, right? So I would always give it maybe not as much prominence as engineering and, when you're first getting started and so forth, but always have it in the back of your mind. I need to build out this team. Like, where am I going to find these people from? Not dealing timely with the tax issue. You have to hit those head on early. Otherwise they become incredibly expensive. And the IRS don't care, right? Rules are rule, and they'll apply the rules. Get auditors as soon as possible when it makes sense, and start setting up the audit committee. You want these objective, independent voices. You're going to have to invest in systems to support the growth. You don't want those systems to break down at the worst time. And then the last one is just going public before you're really ready to be a public company, having that infrastructure in place. So that is it.
Okay. Any last questions? And I always make the comment that you don't want to be sitting there 3 years from now and saying, "Gee, I wish I had asked a question like Danny when I had the chance."
You're thinking about
saying
this,
that you're going anywhere, but you won't be here.
Well, hopefully, yeah.
Yeah. So any questions? Now would be the time.
So corporate card, like being given out to employees has gone down like a lot over time.
Yes.
And also people spending on corporate cards, like you're not buying someone's wife a watch to like make a deal happen or something.
Yep.
So do you think then that's going to be more popular now because the consequences of like having, all these expense reports and, like especially with like the macro returns being, like a thing to happen very easily, or do you think that it's just going to be less corporate cards in general still?
Well, I think, to be honest, I think what's really helped is remote work, right? Because people aren't traveling, they're not having dinners, events are much less now. So I would think that's hopefully that's going to tail off. Yeah.
There's another question on this side.
Yeah, obviously a kind of big part of this was like investing in young personnel and people early on. But then I know like earlier you kind of noted that a lot of times these companies don't have the money to actually like hire a full-time CEO or in-house personnel. Like, where do you think that sweet spot is where would you personally recommend that an early stage startup actually start with really investing in accounting personnel?
I would say probably maybe after a Series B. It was a reasonably large Series B to start building out the team. Because you're on the verge of getting customers at that point.
No. I mean, I guess my sense too would be there might be some preliminary things you could talk about at a fairly low price, and then use that information. It's almost like, going in and saying, well, give me a sort of a quick diagnostic, and then you kind of go from there might be another option.
Yeah.
A lot of people that bring more people from your experience. What are things that you're looking for that is like, oh, this person has a lot of connections? Because you can't just tell the interview.
Yeah. I mean, a lot of it is, it's really the word on the street, to be perfectly honest. I mean, a lot of these background checks that you do, like if you ask for a reference check from a company, you're gonna get a standard letter.
Are there like certain questions that you ask them to get that kind of like?
Probably focused on their experience, right? So, tell me about that deal, tell me about this deal. Yeah, and then you really want someone who like was actually doing the work, right? Not someone who's just coasting on the work of others, right? Because when you're a startup, you need someone who's going to roll their sleeves up and like really get stuck in.
I have a question from the standpoint of a student,
Yeah.
maybe. Can you give an example? Something that you were, I don't know, frustrated, amazed that somebody that was a CEO, a startup or something about accounting that like, how did they, what class did they not take? How do they not know?
I think that's, to be perfectly honest, I mean, I think if they don't have a finance or accounting background, I mean, accounting is a little bit of an art. I think their perception, the mistake you can make with accounting sometimes is thinking common sense. That's how the accounting is going to follow, and it's not necessarily true. So maybe things like, oh, I got the cash from the customer, we signed a deal. Why can't I recognize all that as revenue? Right. And you have to explain, well, your performance obligations where you said you were going to do these 20 things and you've only done 2 of them, right? And then explaining how that works. Normally around revenue is probably the biggest one.
Okay. Anything else, guys? All right, let's give Janet.
Thank you as always. Yeah.